welcome to the Deep Dive. Today we're unpacking a really fascinating project. It's operating right at the intersection of, well, high-performance crypto infrastructure and, frankly, global regulatory chaos.
Yeah, we're talking about Onyxcoin or XCN.
Exactly.
Yeah.
And this isn't just about another token. It's more of a deep study in how these cutting-edge tech advancements, specifically Layer-3 architecture, are colliding with the very messy reality of global finance regulation.
That collision is the perfect word for it. And that's really our mission today. We're synthesizing, three totally different streams of information. First, you have the super technical white papers on XCN's stack and its utility.
Right.
Second, the massive news drops from this year, 2025, things like gas-free wallets, AI tools for developers. And third, these high-level regulatory discussions, the kind coming out of Wharton, that are debating who is actually liable for decentralized code.
And that last point is really the core tension, isn't it? On one hand, XCN is building this robust, compliant infrastructure. It's aimed at institutions. But at the same time, they're releasing these friction-free tools for retail.
Pushing the envelope.
Totally. They're integrating AI, they're getting rid of gas fees, which everyone hates. But the token itself is facing extreme volatility. I mean, it's down over 85% from its highs. So we need to understand how they plan to pull all this off.
A very tricky balancing act.
Okay, let's start at the foundation. When we talk about XCN, we have to talk about its core utility. What is Onyxcoin and what does it actually do?
So fundamentally, XCN is the engine that runs the Onyx Layer-3 ledger. It's an ERC20 token, so it lives in the Ethereum ecosystem, but it serves a few really critical roles in its own environment.
Okay.
It's the native gas token, so it pays for transactions, it gives you discounts on services, and crucially, it's the governance asset for the Onyx DAO.
And that governance piece, when you dig into it, that's where you see the huge institutional focus. The thresholds are massive.
They are strategically massive, yeah. We're talking about needing a minimum of 100 million XCN in governance weight just to submit a proposal.
100 million. And what about to get it passed?
To get that proposal approved, you need 200 million XCN votes. That's a huge barrier to entry.
So that sounds less like pure decentralization and more like an institutional moat.
Yeah.
Something to keep out frivolous proposals.
That's exactly what it is. It's designed so only serious players with serious capital can steer the ship. This is what institutions need to see. Stability, security.
Makes sense. What about the supply, the tokenomics?
The max cap is around 68.89 billion XCN. Right now, the total supply is sitting at about 48.4 billion.
And how is that managed? I mean, you need to fund growth, but also create scarcity.
They use a pretty sophisticated dual mechanism for that. On one side, you have emissions. The time-locked treasury releases 200 million XCN every month until 2030. That's for developer grants, incentives, that kind of thing.
Okay, so that's the inflation. What about the other side?
For deflation, they integrate Ethereum's EIP 1559 model.
Right, the famous burn mechanism. So for anyone who isn't deep in the weeds on that, what does that actually mean for XCN?
In practical terms, it means a part of every single transaction fee on the network gets permanently burned. It's just gone, removed from circulation forever.
So network usage is directly tied to token scarcity.
Exactly. The more the platform is used, whether by institutions or DeFi apps, the faster the token burns. It's a natural counterbalance to those monthly emissions.
That is smart. Now let's talk about the tech itself, the Layer-3 architecture. We all know Layer 1s like Ethereum, Layer 2s like Arbitrum. What's the point of a Layer 3?
Think of it like a highly specialized, custom-built factory floor. L1s are the city roads, L2s are the major highways connecting cities, but L3s are the dedicated private rail lines going straight to one factory.
I like that analogy.
Onyx is a modular L3, and it's built using Arbitrum Orbit. Orbit lets them spin up these application-specific rollups, meaning they can customize every single parameter. Throughput, fees, data compression, whatever a specific partner, say a major bank, might need.
So they're basically just cherry-picking the best tech from the layers underneath.
Precisely. They use Arbitrum Orbit for that customization and speed. Then they settle their transactions on Coinbase's base Layer 2.
Which gives them security and, a compliance-minded partner.
Exactly. And for data availability, which is what keeps costs super low, they use a system called AnyTrust. This whole modular stack means they get maximum speed, max customization, and they inherit the security of these huge L2s.
And the end result is this dedicated high-throughput environment that's perfect for things like institutional finance or real-world asset tokenization, use cases that just can't handle network congestion.
Right. And of course, you can't be a private rail line that isn't connected to the global supply chain. So XCN uses major bridges like Wormhole and Superbridge to connect to Base, BNB Chain, and other big ecosystems. Liquidity has to flow.
Speaking of seamless, let's talk about the recent product launches. This is where they've really tried to eliminate user friction. The biggest headache for any new crypto user is gas fees. Onyx says they have a solution.
Yeah, this is where the tech gets really exciting. Back in August, they launched the Onyx Smart Wallet, multi-chain support. This wallet lets retail users send XCN completely gas-free.
Gas-free? How?
They do it using something called ERC-4337 account abstraction.
Okay, account abstraction, that's a bit of jargon. Can you break that down for us?
Sure. Think of your normal crypto wallet as a very basic cash register. You can only do one thing, pay. Account abstraction turns that wallet into a smart automated assistant. It can follow complex rules.
So it's more flexible.
Way more. In this case, the wallet knows it can execute a transaction and have the gas fee paid by someone else, a sponsor.
So the user clicks send, the transaction goes through, and the fee is covered by the network itself through the Onyx DAO.
Yes. The DAO sponsors it. But here's the genius part. Every time the DAO sponsors a transaction, it automatically triggers a proportional burn of XCN in the background.
Ah, there's the loop.
There's the loop. You get a gas-free experience for the user, which drives adoption. And by the way, active users surged 32% after launch. And at the same time, you're creating deflationary pressure. It turns user friction directly into token scarcity.
That's a phenomenal flywheel. Rewarding usage while increasing the token's value. And the innovation isn't just at the user level, right? They're also tackling friction for developers.
They absolutely are. With the deployment of Onyx AI v2 just a few days ago, on November 20th, this is an AI-driven ledger system designed to simplify deploying tokens and dApps.
How does it simplify it?
Developers can use natural language prompts. They're essentially just talking to a GPT-4-based system to generate and deploy their code.
Wait, so instead of needing deep expertise in Solidity, I can just tell the system, build me a yield farming contract with a 1% fee, and it helps me do that.
That's the vision. It dramatically lowers the barrier to entry, and the early metrics are powerful. They've already seen a 17% reduction in deployment errors.
That's huge.
It positions XCN as more than a payment rail. It's the utility backbone for the whole ecosystem, attracting projects that want to build fast and reliably.
Now let's widen the lens a bit, because despite all this incredible tech, the market picture is, well, it's challenging. Accessibility is up. They listed on eToro in July, which opened them up to 35 million users, but the volatility is just extreme.
Oh, yeah. That initial 43% rally after the eToro news, it completely evaporated. The token's retraced 72% since then, and it's sitting, like you said, 85% below its January highs.
So why is there still this cautiously bullish feeling in the community?
I'd say it's driven by two main things. First, really aggressive staking APRs, sometimes as high as 56%. And second, this very public pivot toward regulatory compliance.
That compliance angle is critical. They're specifically aiming to meet U.S. Clarity Act standards. That's a huge signal that they're building for big institutional money.
Exactly. They're showing that their tech roadmap is tied directly to their regulatory roadmap. And we're seeing it play out. The Goliath testnet is live. It includes their Slingshot DX. They're building the on-ramps now, hoping the tech is ready when the regulatory fog finally lifts.
Which is the perfect pivot. Because we have to talk about how this amazing technology is running headfirst into the most ambiguous legal questions in the entire industry.
This is where success is no longer just a technical problem. It's a legal one.
Right. Let's start with the non-custodial liability paradox. The Onyx Smart Wallet is non-custodial. You hold your own keys. Traditionally, that means the software provider isn't liable.
Traditionally, yes, but that view is dissolving fast. The DOJ enforcement actions against groups like the Tornado Cash developers and Samurai Wallet have created this terrifying new reality for DeFi developers.
What's the new argument?
Regulators are arguing that if the software helps move assets and the developers have any significant influence over that code, they might be considered to be engaging in money transmission.
So the very feature that makes it decentralized, the lack of central control, is now being seen as a liability risk for the people who wrote the code.
It's a huge paradox, and it creates enormous uncertainty. If people use your open source tool for bad things, who's on the hook? The response from bodies like IOSCO has been to propose identifying responsible persons.
Who would that be? A responsible person?
They're targeting the influential players, founders, core developers, or DAO participants with significant voting power, like those people holding 100 million XCN. The idea is to create accountability by focusing on people who can influence things like code upgrades without trying to regulate the decentralized tech itself.
Regulate the people, not the protocol. That makes sense. And it leads right into the next regulatory nightmare: smart contract governance. Should contracts be upgradable? And if so, who is responsible when the code fails?
This is the classic dilemma. Is it a product liability issue or a regulatory compliance issue? If a centralized team pushes an upgrade, they're clearly liable. But what if the contract is truly autonomous? Is a failure a bug? Or is it just a user executing the code exactly as it was designed?
Like that Mango Markets incident where a user exploited perfectly functional code to drain the protocol. Was that an attack or just a clever trading strategy?
Exactly. The legal precedent is being written right now in real time. And for a project like XCN with its strong DAO and controlled emissions, they're going to face a lot of scrutiny about their level of influence.
And this legal mess just gets magnified on the global stage. We've gone from a fragmented industry to a fragmented regulatory landscape.
It's a total maze. Just look at the EU's MiCAR regulation. It's praised for being comprehensive, but privately, firms are calling it regulatory overkill. The compliance costs are enormous for a project like Onyxcoin that needs to operate in Europe, Asia, and North America all at once.
And a token like XCN, which does so many different things, makes the regulator's job even harder.
Absolutely. XCN is a utility token. It's a payment mechanism, especially with those gas-free transfers. And it's an investment through staking. Regulators can't just call it a currency or a security. They're forced to use what they call a function-based approach.
Meaning what?
It means they don't care what you call it, they care what it does. If you use XCN to pay for something, it might be regulated one way. If you stake it for yield, it could be treated as a security. And that leads to these wildly inconsistent rules across borders. It creates huge instability.
So we have this world-class tech running into this world-class regulatory friction. And the market really reflects that perfectly. Let's look at the numbers. As of today, November 2025.
The current price is hovering around half a cent, about $0.0555. That's a staggering 85.3% drop from its all-time high back in January.
And the volatility.
The 30-day volatility rate is at 143%. And right now, the technical indicators are just overwhelmingly bearish.
It's a bloodbath. But analysts always say that extreme volatility is where you find the best long-term opportunity. Is that the argument here?
That is the core bullish argument, yes. One analyst compared XCN to an established coin like Stellar or XLM. XLM has such a massive market cap, its potential for, say, a 100x return is basically zero.
Too big.
It's too big. But XCN, because of its low valuation, has a much clearer runway for that kind of exponential growth. A target like $1, which would be a 90x return, is at least in the realm of possibility during a full bull market.
And that's all based on the hope that the L3 adoption will eventually create real value. What do the long-term algorithmic forecasts say?
The models are pretty optimistic about the infrastructure play. They're forecasting a potential high of about 5 or 6 cents by the end of 2025. That would be a 10x from here.
And further out?
Looking further out, the prediction for 2030's maximum price is around 12 cents. That's over 21 times the current price. By 2040, projections are getting up near 40 cents. The market is just waiting for institutional adoption to really kick in.
What a dive. So we've explored this incredibly complex Layer 3, designed to eliminate friction with some truly innovative tech. But we've also seen that all of that innovation depends completely on solving these huge regulatory questions around decentralized liability.
Yeah, XCN is really fighting a battle on two fronts. Its success is going to be measured just as much by its ability to secure a favorable legal status as it is by its technical power to attract institutions. The risk is high, but the opportunity is just vast.
Which leaves us with a final provocative thought for you to consider. Onyx is embedding advanced AI directly into its ledger for autonomous tasks, things like automated risk detection. If these AI agents driven by smart contracts start acting on their own learning, transacting, governing without any human input, how long until regulatory liability shifts from the human developers or these responsible persons to the self-executing AI agents themselves? And what kind of governance would you even need for code that's constantly learning and acting completely outside of human control?